Hello, everybody. So today we're going to cover why gold isn't falling, even with war and inflation. So gold's down, inflation fears are up, but it's right where it is. So gold should be soaring right now. The United States just struck Iran 2 weeks ago. Inflation fears are rising again. Geopolitical tension is everywhere. And yeah, gold is falling. So what's going on? Today we're going to break down why gold isn't reacting the way everyone expected, and why institutions are actually favoring the United States dollar instead. Most retail investors follow a very simple rule. War equals inflation. Inflation equals higher gold prices. Historically, that logic has worked. Gold has always been seen as a store of value during inflation, war, and uncertainty. So when the US-Iran conflict escalated, many traders expected gold to explode higher. But markets don't move based on simple narratives. They move based on macro transmission mechanisms. The transmission chain is basically how investors determine if an event is just temporary, that is transitory, or a structural regime change, cause for a structural regime change. Now, if you don't know what it is, I'm going to go into detail on my Substack, and I'm also going to make a highlight video about it on my YouTube channel here. So regarding gold, institutional investors ask a different question. Is this event just a temporary shock, or is it a structural regime change? Right now, the conflict looks like a shock, not a regime shift. Why? Because we're not seeing major tightening in credit conditions yet. A true regime change usually spreads throughout the financial system. Credit becomes tighter, liquidity dries up, growth expectations collapse, and markets reprice globally. This hasn't happened yet. So, institutions aren't necessarily repositioning for a new economic regime yet. Instead, they're just looking for the safest place to park capital during the shock. And that brings us to the second point. Why the dollar is winning. In this environment, the dollar is winning the safe haven trade. And there is an important structural reason for that. In the past, when Middle East conflicts pushed oil prices higher, it hurt the US more. But today, the US is a major energy exporter. That changes the macro equation. Higher oil prices can actually support the dollar. At the same time, because commodities are priced in dollars, a stronger dollar makes energy more expensive for the rest of the world. So the economic pressure hits important countries harder than the US. This global squeeze creates demand for the most liquid, stable asset in the system, i.e., the dollar. To go further, let's explain why gold isn't winning. Gold still has a long history as an inflation hedge, but right now it has two problems. First, volatility. When institutions are seeking safety, they often prefer assets that are stable and liquid. Gold can move violently during macro shocks. Second, profit taking. Gold already had massive rally before the conflict, creating high highs after high highs. All-time highs, actually. So, when markets face uncertainty, traders often lock in gains rather than chase the move higher. So instead of gold continuing to melt up, we're seeing capital rotate towards the dollar. Now, if you're a little bit fundamentally handicapped and just rely on the technical picture, price action, let's have a look at the chart. Chart basically tells a similar narrative. Gold actually repriced lower after the strike on Iran. And when news came out suggesting the conflict might de-escalate, gold didn't rally strongly either. Instead, price action followed its negative correlation with the US dollar. As the dollar strengthened and gold weakened. Macro flows lead technical analysis. If you want to learn more about macro flow and fundamental analysis, you can check out my Substack, link in the description. And I'm also going to be making more videos explaining drivers. You can see the direction capital flows before price action tells you what it's going to do. To go a bit further in explaining just a bit of a bonus. There's also potential stagflation discussion happening in the background. If oil prices stay elevated, global growth could slow while inflation remains sticky. Again, the US might actually be better positioned than other economies because of its energy production. That gives the Federal Reserve more flexibility compared to central banks in countries that rely heavily on energy imports. Key takeaway is this: the market isn't asking which asset is perfect, it's asking which asset will fail the least during uncertainty. Right now, institutions believe the answer is the dollar. But if this conflict spreads and starts affecting credit markets and economic growth, that could change the entire regime. And if that happens, gold may finally get the move everyone expected. And you can trust me, when that happens, I'm going to make a video and a Substack post telling you what's happening and where it's leading to and the trades you can take. Learn more about macro flows and how to think fundamentally like an institution and quotes. Have a look at my Substack. This post is going to be free. I'm going to make subsequent posts and primers explaining the drivers and basically how to develop a philosophy that can help you track markets and make solid trades. I'm going to go into execution, I'm going to go into analysis, data tracking, and all that good stuff. Subscribe and pay to get into the chat group so you can send messages, ask questions, and basically have a discussion, broaden your market knowledge. I'm also going to be making videos explaining topics like this going forward. If you like this video, click the like button, subscribe, turn on notification, and all that good stuff. I'll see you in the next video.